All right, a really shocking new economic number just came out for India. And, at first glance, it looks like amazing news for the economy. But when you dig just a little bit deeper, you find that the official data is telling a completely different story from what most people are actually feeling in their wallets.
So get this. Here's the number, 0.25%. That's the official retail inflation rate for October 2025. I mean, wow. To give you some perspective, that's the lowest inflation has been since 2012. On paper, that seems like a huge win, right? So that brings us to the real question. Does this number actually feel real to you? When you're out buying groceries or paying your bills, does it feel like prices have just stopped going up? I think for a lot of us, the answer is a pretty clear no. And there's a really good reason why.
And that reason is, well, this number is basically a statistical illusion. The editorial we're looking at here calls it a statistical anomaly, which is just a fancy way of saying it's a trick of the math. It's not a real, genuine drop in the prices that you and I are paying every day.
Okay, so how is this illusion even possible? Well, it all boils down to a tricky little concept called the base effect. So let's pull back the curtain and see exactly what that means and how it's twisting the entire economic picture. Just look at this comparison. This whole illusion really comes down to one single thing: food prices. You can see here that back in October 2024, food inflation was absolutely blistering, a scorching 9.7%. But now, fast forward to October 2025, and it looks like it's plummeted to negative 3.7%. That gigantic swing is what's breaking the whole calculation. And here's the key. Because food prices shot up like a rocket last October, this year's prices are being compared against that incredibly high starting point, or base. So even if vegetable prices are actually going up today, the year-on-year math makes it look like they've fallen off a cliff. That, right there, is the base effect in action. But you know what? The base effect isn't even the only problem here. There's an even bigger, more fundamental issue with the very tool we use to measure all this stuff, the Consumer Price Index, or CPI. The main problem? It's basically stuck in the past. This chart shows you exactly what I mean. The official shopping basket that's used to calculate inflation, it's based on how people spent their money all the way back in 2012. And look at that huge slice for food and beverages. It makes up a staggering 46% of the entire index. So when you give almost half the weight to just one category, any weird distortion there, like the base effect we just talked about, is going to completely throw off the final number. And this is what's really happening. If you take that weird food number out of the equation for a second, you see that prices for almost everything else, we're talking fuel, housing, all those miscellaneous goods, are actually going up. In fact, inflation in these areas was actually higher this October than it was last October. So the headline number looks great, but for most things, costs are still climbing. The only other area besides food that actually saw a drop in inflation was clothing and footwear. And that's probably just because of some recent tax cuts. So really, all this good news is just an illusion created by one statistical quirk and a specific tax policy. It's not a broad trend at all. Okay, so this brings us to the really serious part. When your official data is so completely disconnected from what people are actually experiencing, it creates a massive dilemma, especially for the folks whose job it is to manage the economy. So on the one hand, policymakers and the media are looking at this official headline number, a tiny 0.25% inflation. But then you compare it to this. A survey from India's own central bank found that what people felt, their perceived inflation rate, was 7.4%. That gap between the official 0.25% and the real-world 7.4% is it's enormous. It's the perfect illustration of how broken this measurement system has become. And this puts the Reserve Bank of India in a truly impossible spot. I mean, think about it. They see the low official number, but they're smart. They know it's a distortion. Still, they're forced to use this flawed data to make these huge decisions about interest rates, decisions that affect every single person's loans, mortgages, and savings. It's like trying to navigate a ship through a storm with a compass that's pointing in the wrong direction. So what's the fix? Well, the editorial is very clear on this. We don't need a band-aid. We need to fix the broken tool itself. It is well past time for an urgent system update. The solution really comes down to a few straightforward things. First, you have to update the base year from 2012, which is ancient history in economic terms, to something much more recent. And second, you have to completely revise the weights in that shopping basket to show how people spend money today, not how they spent it over a decade ago. The goal is simple, really. Create a CPI that actually measures the modern Indian economy.
The source editorial we're looking at puts it pretty bluntly, and I think this quote perfectly sums up the whole situation. This isn't just some boring technical fix. It's an absolutely critical and time-sensitive problem that needs to be solved for the country to make sound economic decisions.
And that really leaves us with this final important thought. The inflation number is supposed to be the economy's compass. It guides our leaders and helps all of us understand what's happening. But if that compass is broken, if it's pointing in a direction that just doesn't match reality, it begs the question, how can we have any confidence that we're heading in the right direction at all?